Um, Common reporting standards is big news in this region. For us at Wragge Lawrence Graham, our day job really is doing business succession planning for the business families in the region. But this whole area has now become something like 70% of our practice. So I've ended up being in Indonesia every week now, in Jakarta mostly. It's big news because it's not widely understood how CRS will work in practice. The financial services community has tried to explain, but it does need some more work from us all to get the message out to all of our underlying clients and also industry generally. We've been dealing with CRS now for almost a year in terms of our understanding of what the rules will likely be and their practical impact across the financial services sector, both in places like Labuan, Singapore, Hong Kong, and then further afield, BVI, Jersey, Guernsey, etc. So today's presentation is a broad overview of CRS. I've tried to make it very practical. So I've given examples in the slides of its practical application rather than quoting the rules and the regulations and taking you through the rather complex legal language that underpins CRS. If you're aware of FATCA, then this is the global version of FATCA. There are some differences, but there are a lot of similarities between FATCA and CRS. Okay, so we'll get started. So why was CRS put forward as an initiative? It's been in the making now for a number of years. It just didn't come from nowhere. But what was the basis behind it? Well, more recently, it's the OECD meeting in Paris last year in May, where a number of ministers met and agreed the declaration on CRS. Now, here are some of the signatories. I've highlighted Indonesia and Malaysia because it's relevant for today's discussions. But they weren't the only participants. PRC was also in attendance, as well as Japan and Korea in terms of Asia. You'll see that the United States also sent a minister, but as far as we're aware, the US is not intending to be a participating jurisdiction on CRS. So the reasons behind it, it's really to do with tax fraud and tax evasion. So it's the international community's response to the perceived tax evasion that they feel goes on with the use of international centers around the world. So this is the basis on which the OECD have been pushing forward and the basis on which jurisdictions have been adopting the CRS standard. It moves us from what we have got used to under the Tax Information Exchange Agreements, or TIAs, which is a request and prove before you can get information, to an automatic basis. So it moves financial account information from a sort of predicate offense basis, so you have to prove why you need the information in the relevant jurisdictions, to just simple automatic yearly data transfer. Okay, that's a significant change in the environment because it'll take us to a sort of data dump which tax authorities around the world will have to troll through and understand, whereas before they had to actually look at a specific purpose for their information request. Allied to this is the beginnings of full transparency on ownership structures, so cross-border ownership structures. And this is a deliberate area for the OECD in their CRS initiative. They want to, in certain circumstances, understand the underlying controlling persons for international entities, international structures, whether they're trusts, foundations, or just simple company structures. So it's a significant change from what the industry has been used to in the years leading up to this. So how are they going to start to achieve this? These are the two documents that are relevant to CRS. The top document is effectively a country-to-country convention or agreement. Countries typically need to be signatories to this agreement, this convention, before they can access CRS. So for Indonesia, this document was signed in January of this year. It was also brought into force in Indonesia by May of this year. So there's not any other Southeast Asian country that's going as quickly as Indonesia on the implementation cycle for the country-to-country exchange of information. The bottom document is the Common Reporting Standard itself. Now, this document needs to be implemented into domestic legislation in order to make the jurisdiction compliant for CRS purposes. No jurisdiction has yet implemented domestic legislation bringing the standard into effect. Indonesia has indicated that they will bring this in before Christmas for domestic Indonesian purposes. So how does it work then? Okay, CRS works on the basis that it's information sharing. So financial institutions in a domestic jurisdiction will be obliged to review all of their accounts, all of their foreign accounts, and report those foreign accounts to their domestic tax authority, their competent authority. CRS is not about tax deduction, it's not about paying money or anything of that nature, it's about information sharing. So the way it works is domestic financial institutions will be required to investigate and report foreign accounts to their domestic tax authority. The domestic tax authority will collate all of the information that they receive, and then they will beam that information to relevant treaty partner jurisdictions. Okay, that's the basic mechanism. And I've highlighted the documents that govern each of those. So the international community, including Indonesia, has been spending time on the convention, the document on the right-hand side. The CRS standard, the domestic legislation, has not yet come in any jurisdiction that we're aware of. So that's basically what it's about. You financial institutions scan and consider their internationally held accounts, report those accounts to their domestic tax authority. The domestic tax authority then exchanges it with its international treaty partners' tax authority. Okay, so what are these sort of financial institutions? Which are the institutions that will be reporting foreign financial accounts as understood under CRS? Okay, the obvious one is banks. Everyone would expect a bank to be included, as well as a custodial institution. But banks are primarily aimed at for CRS, and there's no surprise that they're included in the list. Trust companies are subject to certain circumstances and meeting certain criteria are also within the reporting financial institution category. Okay, so trust companies, corporate service providers can, in certain circumstances, be obliged to report foreign-held accounts or foreign-interested trusts or foundations. Okay, fund managers. So fund managers would be, in the jargon, investment entities. So they'll be managing assets for other people, for investors. They are also captured within the reporting financial institutions criteria. Insurance companies. You're looking at annuity contracts and you're looking at cash value insurance contracts. I don't think this is widely known that the insurance products are also caught. Not every insurance product, so you're not looking at car insurance or content insurance. You're really looking at this, what's colloquially known as the jumbo life insurance. So what it requires is the specified insurance company to effectively report the cash value, which is effectively the termination or surrender value of the insurance product, to the local tax authority. So whoever's entitled to that insurance product on redemption or on termination would be the reportable person. As I say, I don't think that many realize that the scope of CRS encompasses a big chunk of the financial services sector. Okay, let's just go back to a practical example then. So we'll just talk about a personal account. So this is an account, the example I give, let's say, is an Indonesian tax resident who has an account in KL, right? So there's the account that they're holding in KL. What will happen in practice is once Malaysia adopts the CRS standard, and I'll go through later on the timelines for global implementation of this. So once Malaysia goes through the CRS, all of the domestic banks will be required to scan their accounts for foreign held or foreign interests. Let's say that they, CIMB would scan their accounts and they find this Indonesian individual having a personal account, okay? That's immediately reportable to the Malaysian tax authority. Malaysian tax authority will then collate all of that information from, let's say this Indonesian individual is multi-banked in KL. We could substitute Malaysia for Singapore. It could just as well be. It's whichever treaty partner we're talking about, right? So we look and scan for Indonesian tax resident individuals with an account. We report it to our local tax authority, and then they report it to the Indonesian counterpart. This is on personally held accounts. Now, there's no de minimis amount here. It could be $1 in the account. The CRS hasn't introduced what FAC has got de minimis levels, but CRS has not put that in for personally held accounts. Same approach on insurance products. The insurance policy may be worth quite a small amount, but again, it's still reportable. Okay, that's the basic way in which this will work. Now, the only real way that this works is on the basis of the tax residency of the individual. So a number of clients are in the process of changing their tax residency for one reason or another. So they're moving tax residency from Indonesia to Singapore, as an example. We're seeing a lot of that. Some of it may be CRS driven going forward. Okay, this is by far and away sort of the biggest area for domestic markets. It's how are entity structures reported under CRS. So entity structure is typically a company or a trust or a foundation. And this trust foundation company has an account in a foreign jurisdiction, but behind it is, let's say, an Indonesian tax resident owner or beneficial owner. Yeah. So entity accounts are captured, and I'll run through an example. So we all know that the use of BVI companies regionally is quite a legacy thing. It's been going on for well over a decade plus. So I'll use a BVI as an example because it's so common in the marketplace here. So we have a BVI company, and that has an account with CIMB in KL, or it could as well have the account in Labuan. The first thing is there is a de minimis level for entity accounts. So if you have less than 250,000 in the account, then there's no CRS review of that entity. Jurisdictions may opt out of this exemption, and they may just review every entity account in the same way that you review personally held accounts without any criteria, without any de minimis level. But at the moment, the OECD say that accounts below 250,000, it's too cumbersome to review, and there's probably not there's not a great risk of tax avoidance at that level. Now let's assume that your account is above 250,000 for this BVI company. What CRS is looking at is the quality of what the company is doing. So if the company is engaged in a trade or business, and that constitutes more than 50% of the value of that company, gross income and assets, then there's no reportability on that company. I've got shareholders there, Indonesia, China, and India, shareholders and their percentage share interest. This is what's termed in the language a active NFE, an active non-financial entity. But it does require that company itself to be engaged in a trade or business. Okay, typically, the use of regional companies or even BVI companies as a holding mechanism It's not usually used as a trading entity in of itself. But I give you the example because it's there. All that needs to be, all that's required under the rules is that at least 51% of the value is referable to trading activities, in which case there's no review of the ultimate shareholders. So there's no disclosure effectively. If you don't have trading activities, then you do get disclosure of the controlling shareholders of that company. Now, I've kept the Indonesian individual in green at 15%. Now, the OECD say that if you have a share interest below 25%, no one cares about you. So we're not going to review you. Domestic legislation may, however, bring that down because it's based on FATF guidelines. So I've put 15 as an indicative percentage. It might be as low as 10%. The point that I'm making, though, is not every single shareholder is going to be reviewed. You have to have a controlling interest in the company. Okay? Again, a lot of the clients, a lot of the uses of these companies, it's usually 100% ownership that we have. Now, more typically, we have holding companies. So I suspect in Labuan, as it is in Singapore and Hong Kong, they use companies, or clients will use companies as a holding mechanism. That's quite typical in the use of BVI companies. So there's a holding company. What the OECD say is if the holding company holds trading subsidiaries, okay, and 80%, over 80% of the value of the holding company is referable to the trading subsidiaries, there's no review. You're not looking at a reportable structure. So typically, let's look at an Indonesian example. If you have a Singapore holding company with a PMA, and the PMA is trading, that's going to be an active NFE structure. In the same way as you could be having a Labuan holding company or a Hong Kong holding company. It's all to do with the substance of what the subsidiaries are doing. Yeah. So if on a consolidated account basis, over 80% of the value of the holding company is referable to its trading activities, no one cares about the 20% that you perhaps are holding liquidity through, or the shareholders behind that structure. That's an active NFE structure. If you can't satisfy the 80% rule, then it's a reportable holding company. Okay? So these are, the reason why I'm banging on, because these are real practical, real life examples that we've got in use at the moment. So I thought it'd be more useful to see how they play out under the rules. Now, another exemption is a listed company. So let's say we have an IDX listed company and we own more than 50% of that IDX listed company. I've got one consolidated BVI company on the example slide, but it could well be that there are multiple companies that constitute the 50% threshold for that IDX listed company. If they all consolidate into one holding company, then that structure is an active NFE for CRS purposes. So the holding company and the affiliated companies are not reportable companies. Okay. A lot of the sort of IDX investments are via regional centers, so Singapore, Labuan, Hong Kong, a lot of investment into IDX companies here, and some of it will be at controlling shareholding level. If that's where the particular client is at, then their structure is actually an active NFE, and CRS is not so much of a concern for them. Trusts. So I just run through the example of how CRS will apply to trusts. So the trust has an account, again, over 250,000, because that's the threshold level. The reportable persons for a trust are the settlor, the creator of the trust, the beneficiaries of the trust, and any power holders or protectors of the trust. With respect to beneficiaries of a trust, it's only where you have a discretionary trust, it's only when a beneficiary receives a distribution that they become reportable. Okay? So you may have a list of, let's say, Indonesian beneficiaries of a number of discretionary trusts around the world. It's only on the date on which they receive a distribution that they become a reportable person. If, however, the beneficiary has a fixed interest, so let's say they have an automatic entitlement to income from the trust, they're immediately reportable. Okay? The settlor or the creator of the trust is a matter of record. They are reportable regardless of whether or not the trust is revocable or irrevocable, and regardless of whether or not the individual takes a benefit under the trust at all. The only way they're not reportable is if effectively they're deceased. If there was a corporate settlor or a corporate nominee settlor, you will look behind that corporate settlor to the controlling persons of the company or the beneficial owner in which they have been acting in creating the trust. A protector, yep. In terms of the trust analysis? Yes. So what will happen is the OECD split the reporting into existing accounts, so existing entities, and new accounts. On existing accounts, they generally provide a lower threshold test for identification purposes, because they know it's a big burden on industry to have to review everything that's there. So yes, you would have to go through on existing structures that have let's say a bank account or receiving financial services advice, or qualify as a financial institution themselves. You would need to go through the review process of the existing legacy stock of trusts, correct? Okay. Okay, so in terms of whether or not this trust will be reporting its settlor beneficiaries and protectors, we come back to the same thing. Is the trust itself engaged in a trade or a business? It's extremely rare for a trust to be doing this. I have never seen it once, actually. Trusts are always used as a device to hold company shares, typically in the international environment. Domestically, in my time in the UK, trusts were doing this of themselves. But in the international arena, they've generally only ever been used as a holding mechanism for company shares. But this may change in the future. Trusts may get involved in trading activities themselves. And I think that if we were standing here in 5 years' time, I think trusts will be doing a lot of different things than what they're doing now. But let's say that this trust is engaged in a trade. It's the same analysis. Over 50% of its value is referable to the trade. No one cares to review this structure. It's an active NFE. Okay? If all the trust is doing is holding financial assets, then it's reportable. So if all it has is this account at CIMB with $1 million, then it's a reportable structure and will be reviewed. Holding trusts. So this is the typical use of trusts in the international arena. So there we have our trust, and it's the same analysis as with the holding company. If the trust is holding operating entities, operating businesses, and it satisfies the 80% rule, so 80% of this trust value is referable to its operating businesses that it holds, it's not reportable. The entire structure is not reportable. Okay? So you can probably see where the market demand is going to go on trusts. Trusts are likely to become much more involved than has been previously with holding operating businesses, because clients will be concerned about succession, governance, etc., and will want to have a mechanism that can accommodate that. So the use of trusts in the trading arena will probably increase as a result of CRS. If all the trust does is hold these investment companies, it's a fully reportable structure, as we'd expect. Okay, so what's reported? It's basically this. I'll give you a chance to read through. It's a bit like a compendium sort of bank statement that is effectively sent out every year automatically. It'll consolidate all of the financial accounts that the particular non-resident individual has, and it will try and capture all of this data. Okay, so let's look at the timelines. So how's this being implemented globally? And particularly, where is Indonesia at the moment in all of this? What track is Indonesia on? we go back to that multilateral convention. Now, in that convention, participating countries have agreed what's called the Multilateral Competent Authority Agreement. This is the legal document. It's like a subsidiary document to this convention where international countries internationally agree that they will collaborate on CRS and exchange information. This is the current list as at the 4th of June 2015. I've just underlined the main international financial centers that you may be familiar with. The date that you see on the right-hand column is the date on which the relevant jurisdictions will report their financial account data. You need to go a year back for the date on which they will review the data. So if you've got a 2017 reporting jurisdiction, it means that they're reviewing foreign financial accounts in January 2016, so a few months away. Okay. The point about this is, let's say you have a client that wishes to close down their international cross-border trusts or their companies, etc. If they do that during 2016, the closure of the account is reportable. Yeah. Indonesia is now a party to this arrangement. I've highlighted Indonesia because they had come in originally as a 2018 jurisdiction. From what we've now learned at the G20, the recent G20 meeting, I think your finance minister announced that actually Indonesia will push it back. They'll now join in 2017 to receive the data as quickly as possible from the 2017 reporting jurisdictions. So I'll go back. You see that the BVI is a 2017 jurisdiction. The Cayman Islands is a 2017 jurisdiction. Guernsey is 2017. Jersey, Isle of Man, Liechtenstein, they're all 2017 jurisdictions. Indonesia aligning with a 2017 jurisdiction means effectively Indonesia will be receiving information from these jurisdictions. I seriously doubt whether or not there are any individuals from those jurisdictions that are banking with Mandiri. So I don't think that Indonesia will necessarily have much to beam back. It will be a net recipient of data from these financial centers. Okay. What about Malaysia and some of the others, Singapore, China, Hong Kong? These are just indications. So the countries on the 2018 list, Malaysia included, they've indicated that they will join by 2018. You'll see that China, Hong Kong, Macau are there, as is Malaysia highlighted. Singapore has indicated 2018 as their date of adoption. Some countries have indicated nothing, so Panama, Vanuatu, Nauru. Okay, last bit on this is anti-avoidance. I generally don't quote the language from statutes, but I'll highlight it for you. This is the section, Roman 9 of the standard. CRS will come with wide-ranging anti-avoidance provisions. It is left to individual jurisdictions to decide what the anti-avoidance rules will say. The net effect of this will be that in terms of discussions to try and circumvent CRS, try to put structures in place that are going to avoid the reporting, etc., there will be anti-avoidance provisions included in the CRS going forward. Everyone involved from the financial services industry side will be extremely nervous not to infringe these rules. So it's quite an important side because it's likely to be criminal offences to try and avoid CRS once it is implemented. CRS is not in effect, and there is no intention from what we've been analysing for it to be retrospective going forward. Okay, any questions at this point? There's more discussion about this on the panel session, but if there's any questions now, then we can run through it.
I want to, again, build on that question you know, you've got all these signatories to CRS, and you've said that at a certain point in time in 2017 to 2018, there's going to be this massive kind of data, or someone pressing the button and all this data is flying around all over the world, as you say, on highly sensitive and valuable information. Are we absolutely certain that the frameworks and put into place by OECD and all these various other, it's the concept may be fine and honorable, but in reality, given the amount and the extent of cyber fraud increasing in the world today, is it really something that the offshore jurisdictions would be willing to accept?
Yeah, I mean, part of the problem with this is the OECD haven't spent time trying to at least harmonize the legal systems. Now we've got Dutch here, and we've got in Malaysia and Singapore common law, English common law, Dutch civil law. So when you beam information about a protector to an Indonesian authority, tax inspector, it's not readily apparent what a protector is. He's not a beneficiary, he's not a trustee, he doesn't hold anything, he's just effectively an office holder. Now it's quite easy to then make a leap and say, well, you're associated with this account and this money, so there must be something about it that you can do. And that's part of the problem. The OECD haven't been concerned to try and harmonize the recognition of foreign structures and how they'll be interpreted domestically. And I think that's where the likelihood of some discrepancy will come up, is the practical application of all of this. But I do think they will go on the top 10 list. I think they will work it on, let's hit our top 10 list, whoever they are. Problem with that is that it's really financial institution driven. So it's access to financial services. That's the problem. So I think, you know, if you're just thinking like the street level, it's probably going to be a rush to non-financial assets. So gold and precious, you know, chattels and things like this. That's probably, yeah, it'll probably force a growth in other markets as a result of people being concerned about their safety and then the risk of corruption. But it's going to be difficult.
Do they treat the foundations in the same manner as trusts? Yeah. Because as you're aware that the beneficiaries in the foundation do not really have rights to the assets of a foundation until they're distributed.
Yeah, they do that. They do say that you ought to treat a foundation as effectively a corporate trust in many respects. So council members are in effect trustees, founder is settlor, beneficiaries are beneficiaries. So they do use foundations in the same way. They do analyze them in the same way. What I would say is, just going back to the previous point, there is a legal challenge on FATCA, which is making its way through the courts in Ohio. They had a hearing on that, an injunction hearing a couple of weeks back. We're tracking that case. There's also a bill in the Senate to revoke or repeal FATCA, which is being sponsored by Ron Paul. Ron Paul is a presidential candidate that has no chance of beating Trump, but still, he's there. We'll have to see. A lot of what we're hearing is that part of the international financial centers that were originally 2017 cycle jurisdictions have been looking whether or not they can push back to see what happens on the US election. So you've seen that FATCA has now been delayed for another year. So it's interesting. We'll see how this plays out. But for the moment, I think it's just take it that this is coming and that this will be implemented. But there is certainly some level of agitation to push back now.
You mentioned that when a trust or an offshore company is trading, the definition of trading, is that an active business, or could that be just rotating your stock once a year, sell everything off today, bed and breakfast it and buy it all back tomorrow? The
best thing for that is sit with the local accountants and work out what's the industry standard with respect to the local tax authority for what they see as a trading activity. If you're doing a common law system, it would be the badges of trade, which is basically a cop-out by the courts to not give you a formula. So it's really just sit with the local accountant and see, do we pay income tax, or has anybody else paid income tax on the basis of these activities? that's really the more pragmatic way of dealing with this, because when it comes time to do your self-certification, this is all driven by self-certification, you'll tick the box, we are active NFE. At that point, the financial institutions don't need to audit you. It's not their place to audit, they're just taking the form. But if they do look into it, you need to verify and prove that. Then it's best to have an accountant's report behind it, demonstrating being paying tax on this basis, and there's established case law, etc., that this is actually a trading activity. Some of it's very obvious, like factories and stuff, but borderline where you're trying to make an investment business into a trading business, that's where you need very, very careful advice. Well, the easy thing, I think the easy thing for this is CRS. I think the OECD know their limitations, so they've just said gross. They don't want you to net down. You're just doing gross. Yeah. So you don't need to be making a profit. Okay, you could be happily making losses forever. It's right.
Isaac, does this apply to private placement life insurance?
Private placement life insurance.
Yes.
Okay, the whole area on life insurance, the best way to analyze it in a pragmatic way is, can you surrender the policy and will it return more than the premiums paid? That's the easiest way to analyze CRS. It's quite detailed in its application, but they're not looking at things like a term life insurance where there's no investment linkage, you just simply, it'll effectively terminate at age 90 or earlier death. They're not looking at that, but they're looking at insurance wrappers where you could have an investment kicker if you were to terminate or borrow against. That's the key indice there. But with all these insurance, it's very important to look at them very individually, okay? Because the test for this on CRS is much more particular than for anything else they have in the legislation. But it's very much geared around, if I were to surrender or terminate, would I get more back than I've put in? That's generally what they would use as an indice for cash value. Yeah. Again, it's gross, right? So if you've borrowed it's gross. It's the gross amount you get back, not net of borrowing to fund the insurance product. Well, remember, this is not so much geared towards at the ground level. It is tax driven, but at the CRS level, it's just information. It's just noughts. They don't care basically. It's just a bunch of digits that they're going to be beaming. What's done with that information when it arrives is just basically a verification audit. Okay, any more questions? Okay, good. All right.
Thank you, Zac.
Thank you.
Thanks for the insightful presentation, and thank you, gentlemen, for your questions.